the US dollar lost 75% of its purchasing power. Stated differently, we had several years where the official inflation rate in the United States was in double digits, compounded. Yeah. I think then it's no surprise that the gold price rose 30-fold. I'm not suggesting, by the way, that the gold price is going to rise 30-fold this time, because the gold price has already risen substantially. I am suggesting, however, that it makes arithmetic sense to me that the increase in the nominal gold price will mirror the decrease in purchasing power of the US dollar.
The June CPI inflation report has reinforced expectations that the Federal Reserve will hold interest rates steady at its upcoming meeting. According to the CME FedWatch tool, the probability of the benchmark federal funds rate remaining in the 4.25% to 4.5% range jumped from 93.8% to 97.4% following the release of the data. While headline inflation remains elevated, the central bank appears cautious about loosening policy too soon amid persistent price pressures and a weakening dollar. RickRule of Rule Investment Media highlights that gold's strong performance in 2025 is rooted in a deeper issue: persistently negative real interest rates. As Rule points out, if the 10-year Treasury yield is 4.5%, but actual inflation is closer to 7.5%, then investors are effectively losing 3% annually. In that environment, gold becomes increasingly attractive, not because it generates income, but because it preserves purchasing power. This erosion of real yields has helped drive a massive reallocation into precious metals. The weakening of the US dollar has become a key catalyst, particularly for central banks in China and other emerging markets, which are accelerating gold purchases as a hedge against dollar-based assets. Gold exchange-traded products have seen their net assets swell to $326 billion, mirroring the growing disillusionment with the greenback. The dollar's fall has been nothing short of historic. In the first half of 2025 alone, it has lost nearly 11% of its value, marking the steepest decline since 1973. This collapse has only intensified the shift toward gold, as investors and institutions look for stores of value in a climate of monetary and fiscal uncertainty. Rule emphasizes that gold no longer competes with treasuries in the traditional sense. With inflation-adjusted yields profoundly negative, bonds offer little incentive to hold, particularly when measured against unofficial inflation metrics. For gold, the implication is profound. It doesn't need to rise aggressively in nominal terms to serve its purpose. It only needs to hold its real value. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think the gold market is projecting and signaling negative real interest rates. It used to be that gold competed directly with the US 10-year and the US 30-year. Let's look at the arithmetic around the US 10-year. They pay you 4.5% in a currency which I believe is deteriorating in terms of purchasing power at 7.5% a year. If you believe the CPI number at 2.9 and you're getting 4.5, not a horrible deal. You're making a 1.6% real yield. If you believe, like I do, the purchasing power of the US dollar is declining by 7.5, if they pay you 4.5 in a currency that's declining by 7.5, you're losing 3% a year for 10 years, 3% compounded, which means that they give you back about 65% of your wealth after 10 years. That's what gold, I think, is beginning to reflect. The first time that we had these discussions, David, some years ago, I think that I pointed out the weaponization of the US dollar, which is to say the weaponization of the SWIFT banking system, the use of the dollar to enforce American public policy goals on other countries, and the fact that other central banks had no choice but to begin to buy gold to shield themselves from US politics. That's still true. There's still foreign central bank buying. But a larger issue now, and the reason that retail people are buying it, is simply that the US dollar, as expressed by US treasuries, are a lousy arithmetic deal. And you're starting to see that reflected in the gold price. I think that they trust the US government less than they trusted the US government in the period 1982 to 2020. I think, too, for the reasons that we've discussed earlier, the US dollar or the US treasury is a less good deal than it is. The great unsung reason, of course, is the central banker's realization that the US dollar is the worst currency in the world, with the sole exception of all of the others. As little as those central bankers trust the U.S., they trust each other less. Uh, how many rubles would the Chinese like to acquire? How many? You got my point.
Yeah.
There is no fiat substitute for the U.S. dollar, and there is no fiat substitute.
LBMA, silver's free float has now reached its lowest level in recorded history, with only around 155 million ounces freely available for purchase. This has raised serious concerns about the structural integrity of the silver market. What once appeared to be a deep and liquid market is now showing signs of fragility. According to analysts, this illusion of liquidity suggests that a physical squeeze may be the only path to rebalance the market. Andy Schectman, CEO of Miles Franklin, notes that delivery times at the LBMA have extended dramatically, from just 1 day to as long as 8 weeks. Official explanations point to manpower and logistical issues, but Schectman believes it's more indicative of a scramble to cover growing physical shortages. Behind the scenes, institutions appear to be pulling metal off the exchanges at an aggressive pace. Meanwhile, banks are holding the most prominent concentrated short position in silver ever recorded, once again breaching historical caught positioning norms. The lack of regulatory response is nothing new, but it continues to raise serious questions about transparency and potential manipulation. Are these truly hedges, or speculative bets against a market already under pressure? The paper-to-physical ratio remains extreme, estimated at over 100 to 1 for gold and as high as 500 to 1 for silver, allowing massive price control through paper contracts. Since most traders never demand physical delivery, these markets can be heavily leveraged with minimal metal backing. Schectman highlights a growing divergence. While institutions are quietly rotating capital out of overvalued equities and into hard assets, such as gold and silver, retail investors remain largely unaware of this trend. The signs are there. Big money is positioning itself for what may come next, while the average investor continues to sleep through the shift. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated. The silver market is facing a deepening structural imbalance, with current annual supply deficit estimates ranging between 100 to 120 million ounces for 2024. This shortfall represents nearly 10% of total global demand. Based on ongoing demand trends and the limited pipeline of new mining projects, this deficit is expected to widen further, reaching 150 to 200 million ounces annually by 2026 to 2028. Compounding the issue, above-ground inventory levels are being rapidly depleted. COMEX-registered silver inventories have dropped from over 150 million ounces in 2020 to just around 35 million ounces in early 2024, a staggering 77% decline in warehouse stocks. This steep reduction highlights tightening physical availability and mounting pressure on the broader supply chain. Investment demand remains a significant driving force behind the tightening market. According to the Silver Institute, combined ETF and physical investment demand totaled 329 million ounces in 2023, and this figure is expected to rise further as upward price momentum attracts more capital. Retail and institutional investors alike are turning to silver as a hedge against macroeconomic uncertainty, creating a feedback loop of rising demand and dwindling supply. Andy Schectman argues that years of deliberate price suppression have had unintended consequences. It's backfiring, he says. Inventories are depleted, the big banks are losing control, and physical metal is vanishing from the system. Sophisticated institutional players, recognizing the imbalance, are quietly acquiring silver. Schectman believes a breakout is imminent. Once it gets going, there might not be any stopping it, he warns, suggesting the market may soon reprice dramatically to reflect the underlying fundamentals. Let's get back to the interview. Beneath layers of derivatives and delayed deliveries lies a silver market stretched to its thinnest thread in decades. Inventory depletion, unchecked leverage, and widening deficits are converging into a storm that no amount of paper can mask. The sharp divergence between institutional behavior and retail inaction is growing more pronounced, hinting at a coming moment where access, not price, may become the actual battleground. With supply chains tightening and structural cracks widening, the pressure beneath the surface may no longer be containable. Could the turning point arrive not through gradual recognition, but through a sudden fracture that forces the world to reprice silver in real time, on real terms? Share your perspective in the comment section. If the video resonates with you, Join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.
Oh, because they were so broadly hated. I added, probably 25% of my junior uranium portfolio was acquired 6 months ago. I sold that when the hate dissipated. I wasn't making a trade on a valuation basis. I was making it because my original trade was based on hate, and the hate is dissipated.
RickRule points out that bull markets in metals often follow a familiar pattern. Gold moves first, and once the rally gains traction, particularly among generalist investors, silver begins to outperform. While the exact reason behind this sequence remains unclear, Rule suggests it may be due to silver's lower price per ounce, which makes it more appealing to retail investors looking to capitalize on the momentum that gold sets in motion. This trend appears to be resurfacing in 2025. After trailing gold for years, silver is now stepping out of its shadow. According to a recent Forbes article by Tim Tread Gold, silver is showing signs of entering a breakout phase, with prices reaching a 14-year high. One key factor driving this move could be the emergence of a new and powerful player, Russia's central bank. Tread Gold hints that the bank may be quietly accumulating silver, potentially as part of a broader strategy to diversify away from dollar-based assets, similar to what many central banks have done with gold in recent years. Silver's price has surged 30.6% since the beginning of January, outpacing gold's 27.5% gain. This outperformance reflects a classic catch-up move, as silver attempts to close the gap with its more prominent counterpart. For years, gold dominated the spotlight, driven by central bank accumulation, ETF inflows, and safe haven demand. In contrast, silver lacked similarly powerful buyers until now. Let's get back to the interview.
No shortage of private liquidity. There may be a shortage of government solvency. Solvency and liquidity are very different terms. There's an awful lot of private liquidity out there. And I think that increasingly private buyers look particularly at the long bond market and say they have to take some risk to get some higher yields because they're getting killed on their bond portfolios. In the period 1982 to 2022, a period of very strong U.S. dollars and falling interest rates, the long bond market was a good and safe place to be. Since 2022, the long bond market has been a slaughterhouse, and money has been forced out of the 10-year plus maturities, both public and private, and into markets. The S&P 500, again, for all its faults, has continued to generate pretty stable and growing earnings. It's concerning to some, myself as an example, that about 40% of the market cap of the S&P is made up for by 9 stocks. It's more concerning to me that those 9 stocks are in businesses I don't understand, so I can't invest in them. But certainly nobody can complain about the performance, the corporate performance of the companies that make up the S&P or the performance of the S&P. For many people, they regard that as a viable alternative. Particularly, they regard it to a viable alternative to the fixed income market, and particularly there to the fixed income market in the very long term. In the context of the global economy, something now like $900 trillion in investable assets. The market cap of gold, as an example, is irrelevant. The market cap of Bitcoin is irrelevant. They're important assets to us because our audience is interested in them and listens to them. But in terms of the global flow of capital, not so much. I think, by the way, it would be useful for your audience if they looked at that chart and understood that this is a nominal dollar chart, not a real dollar chart.
Yes.
If you simultaneously adjust the part for the declining purchasing power of the U.S. dollar, the chart looks much, much, much less dramatic. But I also think that 2 things happened to characterize this bull market. One was an own goal, a self-inflicted wound by the U.S. government on the U.S. dollar, making it difficult for our trading partners and others to continue to use it as a reserve currency. Whether or not you agree, as an example, with Russia's actions in the Ukraine, the United States government stole $300 billion worth of Russian treasuries. not something that endears itself to governments that might find themselves with the prospect of imposing policies that weren't acceptable to the Americans. And then the weaponization of the SWIFT banking system, which is not a U.S. controlled asset, to use the dollar to impose U.S. policies on other countries. It is impossible to overstate the importance, I think, of the U.S. government's own actions reducing the strength of the U.S. dollar. I think that really kicked off the rally. The second factor was the realization in the United States and in other countries that the balance sheet of the debtor, the U.S. government and the U.S. society, is much less good than it was in 1982. In 1982, the on-balance sheet obligations of the U.S. government, which is a different way of saying the money that we owed bondholders net, was about 32% of U.S. GDP. The corresponding figure today in 2025 is that we owe 130% of GDP to bondholders. The number is fourfold higher. In 1982, the off-balance sheet liabilities of the U.S. government, which is to say the accumulated unfunded promises for Medicare, Medicaid, Social Security, federal government pensions, and military pensions, was about one times, GDP. The corresponding number today is about 3.5 times GDP. When people look at the relative strength of the U.S. economy and the U.S. government, the underpinning of the value proposition in the U.S. dollar, what they see is a balance sheet that has deteriorated markedly over 40 years, and one where there does not seem to be the political discipline to control the problem. Those numbers, a $30 trillion net obligation to bondholders, and a $100 trillion net obligation to entitlement beneficiaries, are growing at about combined on balance sheet and off balance sheet $4 trillion a year. To put that in perspective, the gross income of the U.S. government before they pay any money for anything is about $5 trillion. Our on and off balance sheet obligations are growing at $4 trillion a year, while our aggregate revenues are only $5 trillion a year. That chart becomes easier to understand when you observe the math behind it. If past is prologue, it was a matter of time. Whether or not this is an actual breakout or a perturbation in markets, time will tell. But it is a feature of precious metals bull market that the bull market is led by gold, physical gold. When the momentum established by gold validates the precious metals narrative to the generalist investor, and the generalist investor comes into the precious metals space, leadership changes from gold to silver. I don't know why. My suspicion is because of the lower unit price of silver. All I know is that the three prior precious metals bull markets that I've lived through have all seen at some point in time leadership change from gold to silver.
Momentum in the metals market is no longer isolated to gold. It's becoming a broader shift in how capital interprets risk, inflation, and currency decay. As the dollar undergoes one of its most rapid declines in half a century, traditional safe assets are being reevaluated under a harsher light. The rally in gold has been joined by a surge in silver that feels less like a sideshow and more like a strategic rebalancing. The significance isn't just in price, it's in purpose. Could the outperformance of silver mark the beginning of a new monetary era, one where trust is earned not through fiat, but through scarcity and permanence? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.